Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win. Hi everyone. In the last video, I had Carl Kruger with me and he shared some data on real estate and the how extreme the bubble is. How are you doing, Carl?
Good, Mike. How are you?
Good. So you sent me another chart recently, and I just want to show this to everybody. This is, I believe I covered this in my first book. So I've been following this since 2005, I think. And this is the mortgage rent ratio. So how much does it cost for you to make payments on a home versus renting that exact same home? Or if you're making payments on the home and you're renting it to somebody else, how much can you get in income? And
Right.
what you see is with well, you tell me what you
Yeah.
were really attracted to in here first.
Well, I mean, first of all, what just stands out about this chart is, I love charts. You love charts, Mike. I know, and so this just stands out. It just jumps out. Actually, is that the extreme nature of the cost of owning a home now, right?
Yeah.
And this is post COVID, and you can see from the chart, of course, where did this begin? You actually had basically the cost of ownership below the cost of renting prior to COVID. And
Right. So
so,
the average house will cash flow then. You could buy a house as an investment and rent it out and it cash flows.
exactly. Right. And so then the cost just, skyrocketed, of course, with the basically, in my personal opinion anyway, with, the printing of money essentially, right, during COVID with all the COVID related programs. And so the cost of the average home, I think that the number is something like about 260,000 for the average median price home prior to COVID in 2019. That same home today, this is just unbelievable, is now $440,000. Okay,
Uh-huh.
that's if I remember, it's about a 70% increase in the price of a home. To my knowledge, that's never happened in the entire history of the country. And so there's something very different now, as we well know, than was prior to COVID.
Yes. I'm going to zoom in on this a little bit more because I want everybody to see this. This starts out in 1970. And I'm sorry if I'm taking my eyes off the camera for everybody, but like when I'm doing an interview, like I had Rick Rule on a few weeks ago, and I kept on looking away. Well, I was looking at Rick while he was talking.
Sure.
Anyway, so what we've got here is a portion where the price of homes, along with the interest rates, the cost of the mortgage, so it's your payments per month, was below the cost that you could rent it for. Good time to possibly accumulate real estate for rental purposes. And then you see the spread between this. Now, I'm used to seeing this as a single line. This is the raw data. You have the rents and you have the price, the monthly price of the mortgage. And when you divide those two, you get the mortgage rent ratio. And that's what
Right.
I always used to follow. So it's a single line. And when you do that, you can see that there's this natural balance and it'll go above and below that natural balance, pointing out when you're in a bubble or when real estate is undervalued. And this lines up very well with like the, let me see, the gold real estate ratio. When the price of a home is way over the rents, it also tends to be when homes are overvalued, measured in gold or oil or
Sure.
shares of the Dow. Whenever you do a ratio chart, they tend to run in waves where it points out bubbles and undervaluations at about the same time. It's very interesting.
For sure.
But you can see the home at about 400, a little over $400 here at the same time that it's over 800. The payments are $800 and you can rent it for $400. So
Exactly. Right.
obviously 82. So this is the point in time where mortgages were between 15 and 20% for a 30-year mortgage.
Yeah, somewhere in there. Yeah, that's
there was
right.
a day in 1980 or 82 where the Fed funds rate was, I believe, 22% or 20. It's in my
Yeah,
book.
it was in that range for sure.
And then you get to a point in the 90s, the 92 recession. This is right here in it started actually in 89 in the East Coast. And then the first Gulf War just really caused real estate to do this big pullback. And Alan Greenspan lowered the rates, making homes affordable again. And you can see it was in balance. So this would be, if you were doing a ratio chart, this would be like your zero line where things are in balance, wherever it's here, here, and here. And then a huge bubble again in 2006. Obviously, everybody remembers 2006 and 7. And then what happened? And the time to be buying real estate, if you were going to rent it, was in 2010 and 11. That was time to pick up real estate. And now you see the biggest spread between these, although because this is all a linear chart and it's not percentages, this spread is not, this spread here, 400 to 875 is greater than 100%. This spread here, 1600 to 2700.
27, yeah.
Yeah, is not 100%. So it's actually, if this was a single line, this would be a little bit smaller than that one in the 80s.
Oh, that's true.
This is so extreme. It is totally insane.
And that's a technical term, though, Mike. Totally insane, because obviously the backdrop of the macro environment, right? Again, I come back to the post-COVID, the post-COVID programs, relief programs, right, have just pumped so much currency into the economy, and it has to find a home, and it finds its home in all the nooks and crannies. Housing is definitely one of those big nooks and crannies that it's found its way into. And you can see, I mean, this is just, to pardon the pun, but it's off the charts almost, right? Exactly. And so, yeah, absolutely.
All of that currency that they printed, though, runs out one day. All of these gifts that they made to everybody and it was theft. When you create currency, you're stealing from anybody who is holding currency, because you didn't create new purchasing power. You didn't create new goods and services.
That's right.
You created the measurement tool. You diluted the pool of those measurement tools. And it's just like taking a ruler and making it 6 inches instead of 12 inches for a foot. And you say, wow, the ceiling was raised by double. My ceilings are twice as high now.
That's right.
And so so it was stolen from the old method of measurement and transferred. Therefore, it's stolen purchasing power to make a gift to all of the people they were helping with stimulation. And this is what the Federal Reserve is unbelievable, that the people that are running the game, basically the bank in Monopoly or the house in Las Vegas, the people running the game here, the Federal Reserve, the world's central banks, those people don't understand fundamental economics. If they don't understand and they don't belong in their job. If they do understand it, then they're criminals and they belong in jail. Purposely stealing.
I think they understand it very well, honestly. And it's, as you well know, is that, what they're doing is they're borrowing from the future by diluting each dollar that's already in circulation, right? And so, as we all know, it's a hidden tax. Inflation is an expansion of the currency supply. It's a hidden tax on the population. It's far more palatable than passing an actual increase in the income tax, right? And so the primary beneficiary of that expansion of the currency is always the government first. And so the government, I always make this point, is that the government doesn't pay inflation. The government does not pay the rate of inflation. They simply inflate more to account what they've already inflated previously. And so, they don't have that limitation. on the ability to expand the currency supply. And so if inflation's up 3% or 5% or 10% or whatever, then they can simply account for that by the next round of either taxation and or inflation, which is another form of taxation.
Okay, with that, I want to end this video, and thank you very much for doing this.
Great. Good seeing you again, Mike.
Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.